Hello, everyone. Welcome to this week's research team morning call. Today we got quite a few stock counters. We got Nvidia, Frencken, Singapore Airlines, CDL, etc. And we also have for the sectors, Singapore REIT monthly, Magnificent 7 monthly, and also our usual technical analysis and SG weekly. So before we start, just a quick disclaimer. Everything provided in this seminar is for educational purposes only. Without further ado, I'll pass my time to the US team to start Magnificent 7.
Yeah, thanks, Helena. Yeah, so we'll start off with the Mag7 monthly. Our title is The Earnings Growth Moderates to 27%. So I'll explain why we think so. Moving on to the next slide, we'll be looking at just the stock performance for October for the excuse me, for the Mag7. So it rose 5.6%. It's quite a good performance. It outperformed both the S&P 500 as well as the Nasdaq. S&P was basically flat. Our Nasdaq was only up around 3 plus percent. The main reasons why we think that the outperformance was because of the strong quarterly earnings, which I'll get to later, and also that was further supported by the Fed's lowering the interest rates yet again for the second time in this year by another 25 basis points. Yeah, and we believe that these lower interest rates will continue to support the higher equity valuations for the growth-driven Mag7 stocks. For the biggest gainers, there were two, I guess. Alphabet was the biggest gainer. It was up 15% year on year after it delivered stronger than expected results across search and their cloud services. And also Amazon was up around 12% after the AWS growth accelerated again. And just to highlight, so that Nvidia was also the third largest gainer for the month, mainly from higher demand of their GPU infrastructure. And for the laggard, there's only one. It was Meta, who was weighed down mainly by their CapEx guidance, which they actually increased. Moving on to the next slide, we're looking at the earnings recap. So most of the Mag7 companies did or meet their expectations on revenue and earnings. As a whole, for the Mag7 set of companies, the revenue for the third quarter of calendar year, third quarter 2025, rose by 18%. And this is the highest quarterly year-on-year increase that we have seen in 4 years. As for the earnings-wise, it was up 27%. So this is the 10th consecutive quarter of growth, but it did moderate slightly from the previous quarter's 28%. So looking at which of these companies, out of these 7, which of them actually missed earnings? Tesla did miss their earnings expectations, so their bottom line, mainly because of the continued contraction of margins. They had to continue lowering costs, and their average selling prices also was flat. Apple also missed revenue estimates really from supply constraints on their iPhone 16 and 17, and a continued decline in China sales. As for Meta, for earnings-wise, it was really hit by this one-time 15.9 billion tax charge, which we did. It's a one-off, so we added it back. That's why we get the 27% increase in earnings. And also the biggest highlight would be the higher CapEx, which Serena will go into more detail later. As for the hyperscalers, the PATMI increased an average of 28% year on year. So this, we believe, that is driven by the continued strong momentum in their clouds business. And Nvidia's results were also strong. Iqbal will go into more detail for this. As for the guidance going into the next quarter, we also see a continued moderation in growth. But of course, you look at the guidance here on the right side, they're still guiding for an average of around 17% of growth. So it's still good, double-digit growth, but it will be a sort of a moderation from the previous quarters. Now, moving on to the next slide, we'll be looking at Tesla. So for Tesla, they released their earnings. It was earning above expectations, on the revenue side, but earnings were slightly below. Mainly because why revenue was up, because of the deliveries, hit a new quarterly record, and they have a lot of sales really from the ending of the expiration, of the US $7,500 EV tax credit. So we believe a lot of the customers, mostly in the US, rush to buy an EV, and Tesla or any other EV in the US, because they want to take advantage of this $7,500 that was given by the government. So what we believe is, after this ends, which has ended already in September, that we will probably see the fourth quarter deliveries drop significantly, or at least not be as high as it was, because it's now much more expensive to buy an EV. But the bad news is that the average selling prices were flat. Gross margins also were flat because were declining, because they have to continue to compete with the Chinese EVs, and also in the US there are like companies like Ford, Hyundai, who are competing with them on the price. And they did try to combat this removal of the tax credit by introducing lower cost models, but the main disappointment was that it's only $5,000 lower than the previous versions, and yes, it does remove quite a few of the bells and whistles that come with the ordinary standard models. And even if you lower it by 5,000, it's still $2,500 more expensive, because you offset the tax credit. So it's not that it's not as good as a car, and it's also more expensive than it was a month or two ago, right? So that was a bit of a disappointment. In China, sales were disappointing yet again. They only sold 26,000 cars in September, and this is a 36% year-on-year decline, and it's also the lowest sales that we have seen since November 2022. We believe that this is mainly due to the weakening momentum in their model YL, and also a surge in exports from the Shanghai factory. They are continuing to lose market share to BYD, whose growth has slowed a bit, BYD's growth, but they are still maintaining their market share. Yeah. So what we believe is that the majority of the recovery that we've seen in third quarter really came from the US, from this expiration of the EV tax credit, and that it will decline going forward into the fourth quarter and into next year as well, because now the EV cars are much more expensive. And we also believe that the headwinds from China's competition and tariffs are also still very present, and they will still have to fight on cost wise, and margins will get more and more compressed moving forward. And we also believe that they will continue to lose market share to these Chinese EV makers outside of their home country. So not only in China, but also in Europe and in ASEAN as well. So we remain very cautious on Tesla, given these multiple headwinds, and we maintain our sell recommendation and a target price of $220. So that's all for Tesla, and I hand it over to Helena. Thanks.
Thank you, Glenn. Move on to Apple. So for Apple, their fourth quarter PMI was within our expectation. Their revenue underperformed a little bit because they were having supply constraint in their certain models for iPhone 16 and 17. So obviously the iPhone 17 demand was much better than expected it, so they're not able to keep up. So overall revenue grew 8% year-on-year, which is mainly driven by the growth in iPhone and also the continued growth in services. The China revenue actually fell 4% year-on-year, but management were pretty positive. They expected positive growth in the next quarter because they're seeing a lot of traffic going into the Apple store. So for them, it's usually a good indicator that people have a lot of expectation for the iPhone. So overall revenue, they projected to rise about 10 to 12% as they slowly keep up with the demand. So this is a very positive outlook. It's the fastest place that they've grown in the last 4 years, and this is supported by a double-digit iPhone sales growth. And IDC also recently just released the quarter 3 global smartphone shipment. So overall market, it rose 2.6% year-on-year. So Apple was ranked the second. It came in at 58.6 million units. So the first was actually Samsung. They shipped 61.4 million. So I think overall Apple, they do have certain key strengths. They have a solid financial position. Their user base is very massive. And they're also seeing very strong demand for iPhone 17 coming in. So that supports a near-term outlook. But however, because right now the mobile race is really about the AI rollout, and Apple is still considered pretty disappointing in terms of that. They do plan to roll out the Smart Series, but it was delayed to 2026. So far, there's no game-changing AI present to trigger for a major product upgrade cycle. So we think that's the reason why it's lagging behind other competitors like Samsung, who has a stronger AI game. So overall, we still remain very cautious. So we have a reduced recommendation with a target price of $230. Moving on to Amazon. So Amazon's earnings were totally within our expectation. Their revenue grew 13% year on year. So the key factor this time was the reacceleration of AWS, which grew 20% year on year. Their margin actually compressed a little bit due to heavy AI investment. And also for the retail side, they have one-time severance costs and legal settlement charges. So it's because of that mainly. In terms of CapEx, it still remain very elevated, and they do guided that for 2026, it's going to be even higher. AWS, we're still seeing them to continue investment. So they recently announced plan to commit a minimum of 5 billion to South Korea through 2031 in order to establish new AI data centers, along with an investment exceeding 1.4 billion euro in Netherlands over the coming 3 years. At the same time, Amazon is trying to cut jobs. So they've announced they're going to cut 14,000 jobs in major corporate restructuring. So this is part of their broader restructuring initiative to streamline their operations and refocus their resources on priority areas. So we think overall Amazon's outlook remains strong. We're seeing AWS reaccelerating, and advertising is also doing well. So this is benefiting from their rising demand and strategic partnerships. So even though they're doing very heavy AI spending, their free cash flow definitely fell. But like we think as long as it's positive, it's okay because we still view it as a long-term investment phase rather than a weakness. And the reacceleration of AWS is definitely showing a positive sign that such heavy investment is slowly paying off and translating into revenue. And we're also seeing continued effort in cost discipline and investment in AWS. So all these position Amazon well for sustained top-line growth and margin expansion over the long term. So overall, we're still positive on Amazon. We have a buy recommendation with a target price of 260. Now I'll pass my time to Fami.
Hey, thanks, Elena. So, we'll be covering the Microsoft report here. So, first update is that Microsoft released their first quarter results on 29 October. So, it has shown a strong performance, beating its guidance and the market expectation. The group revenue jumped 18% year over year to $77 billion US. So this was led by the Microsoft 365 commercial, its productivity software services, which rose 17% above the guidance of 14%. Its growth driver, which is the cloud services, Microsoft Azure, revenue grew 40%, which is higher than 33% in the same quarter last year. So the cloud services business were accelerating, mainly driven by the infrastructure growth from its largest customer. Noticeable this quarter also is the company's increased the full year capex to further accelerate its cloud computing capacity after seeing its cloud services business have accelerated again this quarter. Next news is that Microsoft and OpenAI signed a new definitive agreement. So this is supporting OpenAI transitions to public benefit corporation. So a few of the highlights is that first, now Microsoft holds about 27% stake in OpenAI Group. It further retains exclusive intellectual property and Azure API rights until AGI is further declared. Third is the API right now extend to 2032. Microsoft no longer has right of first refusal, and OpenAI committed to $250 billion in Microsoft Azure. Last update is that Microsoft intends to reduce reliance on the major chipmaker players. On the 1st of October, the Chief Technology Officer said that the tech giant would like to mainly use its own chip in its data centers in the future. Currently, Microsoft's main GPU is mainly coming from Nvidia, while the smaller amount is coming from AMD. So we are still positive on Microsoft, our view. During the earnings call, Microsoft continues to stressing out that cloud and AI demand continues to outpace supply, even as more computing cloud capacity comes online. Regarding the increase of the capex, that sounds concerning. We believe that actually year-over-year increase in capex has generated comparable returns. If you look at the chart, commercial cloud revenue growth, which is representing the commercial's earnings from Microsoft multiple products, the numbers is approximately 1 time of the capex increase over the past 2 years, meaning that Microsoft is earning back the money it spends on capex, which is contrary to the belief that Microsoft is overspending on capex. And most of these capex was spent on the long-lived assets, meaning that it would be useful in the future to monetize their cloud services business for at least 10 to 15 years. Regarding the new agreement, we think that this would further strengthen the Microsoft and OpenAI partnership. Microsoft is the longest partner was the first one supporting OpenAI back in the days. So the extension of IP rights to 2032 from 2030 and OpenAI's Microsoft committed Azure spent about $250 billion would provide greater long-term revenue visibility for Microsoft. And the committed Azure is also big. The amount is about $250 billion, and this is 63% of the current Microsoft backlog book order, which is $392 billion as of first quarter of 26. Everything that this deals is advantageous for Microsoft. That is also to add that now they have safeguarding the relationship, meaning that instead of OpenAI itself declaring that they have reached the AGI status, now they would have a third party to determine whether the AGI is properly declared or not. So then again, regarding the last news that Microsoft intends to reduce reliance on major chip makers, this isn't like a big news at all, but we just put it here just to say that Microsoft is trying to reduce the reliance on the major chip makers players. They are trying to depend on themselves instead of just relying on the third party. So we maintain a cumulative recommendation with a lower target price of $540, which is lower than previously $550, after expecting slight increase in long-lived assets, which is a capex spending in the FY26. That is all for me. I will pass over to the next presenter. Thank you.
Good morning, everyone. I present Meta and Alphabet. Let's start with Meta first. So last month, the company actually delivered a very strong business result in third quarter, with the ad revenue actually up 26% year on year, driven by increased user engagement and also improved ad efficiency. And other revenue actually grew 59% year on year. This is led by WhatsApp Pay messaging and also Meta Verify subscription. Reality app segment remained to be loss-making, with an operating losses of $4.4 billion, despite the revenue actually growing 74% year on year. It's driven by substantial AI glasses revenue and retail partners actually stocking up on Quest headset ahead of the holiday season. So moving forward, the company actually announced that they are raising capital through a bond offering that worth up to $30 billion to support the AI expansion. This is actually a 6-part bond sales, with the maturity ranging from 5 to 40 years. The company also secure a financing for the $27 billion data center campus in Louisiana via a joint venture with asset manager Blue Owl Capital. So Blue Owl Capital will actually own 80% of the stake, and Meta will actually own the remain 20% of it. Despite reporting a very strong quarterly performance, the stock performance actually not doing so great. It fell more than 10% on the result day. It's driven mainly by the higher financial year 26 capex guidance to support the super intelligent lab. So in financial year 26, in the last earnings calls, the company actually mentions that the capex dollar growth will be at a similar pace at financial year 25, which is about plus $30 billion basis. But now Meta actually expect capex and also OPEX to increase significantly in terms of dollar growth in financial year 26 than this year. It could imply a capex might actually exceed $100 billion. So we are slightly cautious on Meta spending pace, because currently it provides very minimum information about how to monetize super intelligent lab. But we actually think that Meta approach to leverage external financing partner is actually useful to ease some of the financial burdens, and it also helps to speed up the AI infrastructure build up. But overall, at the moment, we are still maintaining very positive view on Meta core advertising business because it's still showing a very strong monetization capabilities. And in terms of pipeline, it still presents a very solid growth potential. The pipeline includes like threads and video. So this is why for Meta, we actually have accumulate recommendation with the target price of $770. Next for Alphabet. Next slide, please. Thank you. So the company also delivered a very solid performance and reported the first quarter revenue which surpassed $100 million. So search advertising revenue actually grew 15% year on year to $56 billion. This is led by retail and also financial services. YouTube ads also grew at 15% year on year. It's driven by their improved monetization in shorts specifically. And cloud still remain the fastest growing segment for the company. The revenue actually growing in 34% year on year to 15.2 billion. This is driven by three reasons. The first one is because of a bigger GCP client base. And the second one is that they managed to sign a larger deal than that before. And the third one is that they have a deeper relationship with the existing cloud clients and then they actually currently adopting Google Gen AI portfolio. Moving forward, we actually do believe that this dual revenue stream, which is ads and cloud, will continue to support Alphabet overall robust growth. And we also think that the company is actually well positioned among Gen AI competition and competitors because it's currently showing a very strong ability to integrate and also monetize AI across the core product offering. And then they actually launched a Gemini 3.0 last week. So we believe that this new version of Gemini will actually help to improve their ad business in terms of delivering a better user experience, and it also helps with improve the precise ad targeting as well. So this is why for Alphabet, we actually have a buy recommendation at the target price of $340. Yeah, and that's all from me. I'll pass the time to Iqbal. Thanks very much.
Thanks, Serena. I'll be presenting on Nvidia's portion for Mag7. Yeah, so in terms of Nvidia's results, it's within our expectations. Their data center segment drove revenue and PATMI growth. Like as you can see in the chart on the right-hand side, revenue, which is the blue color line, increased by 62% year on year. And for PATMI, it increased 65% year on year. And Nvidia also announced very strong visibility till the end of next year itself. They mentioned they have visibility to $500 billion of Blackwell and Rubin GPU sales in these 2 years. So we estimate about $380 billion worth of GPU sales for the remaining 5 quarters. So that's about 67% year-on-year increase for each quarter. So, and on top of this $500 billion guidance, they also announced new deals. So they have a agreement with Anthropic to invest up to $10 billion, and as Anthropic build up 1 gigawatt of data center compute capacity, they will also use Nvidia's Blackwell and Rubin GPUs. And Nvidia also announced an agreement with Saudi Arabia to deliver about 500,000 GPUs over the next 3 years. So that can bring a potential revenue of $20 billion more. So overall, our comment for Nvidia is there's some concerns about circular financing, and but we think these concerns are warranted, but we think it is still immaterial at this point in time, because we estimate it to make up about less than 10% of Nvidia's remaining the $380 billion revenue guidance till the end of next year. And we still see a lot of organic demand for Nvidia's GPU chips. For example, hyperscalers like Google and Amazon increasing their CapEx guidance, as well as demand from sovereign countries. For example, the European Commission allocating 20 billion euro to construct 4 AI gigafactories, as well as South Korea government and major tech firms signing deals for over 260,000 worth of Nvidia GPUs. Yeah, so we are still seeing a lot of demand for Nvidia's GPUs itself, and we are still positive. Yeah, next slide, please. I'll elaborate more on the earnings for Nvidia later. Yeah, so overall, to wrap up, Mag7 companies mostly beat revenue expectations for this quarter. Third quarter revenue increased by 80% year on year, which is the highest quarterly year on year increase since in 4 years. And also the PATMI increased by 27%, which is the 10th consecutive quarter of growth, a slight moderation from previous quarters, 28%. And we also see hyperscalers third quarter operating margins increase by 17 basis points sequentially, which is the 10th straight quarter of sequential margin expansion, which we think indicates growing return on investments on their AI investments. As for Apple, iPhone sales increased 6%, which is and because this is their first quarter with the new iPhone 17, but because of supply constraints, it kept their growth. Overall for Mag7, we maintain over it. Except for Tesla, we think that the Mag7's earnings growth will outpace both the S&P 500 and Nasdaq. And we see the tailwinds for Mag7 include greater adoption and demand for AI from sovereign countries like the EU, the UAE, as well as the US government's AI action plan unveiled in July, as well as more rate cuts expected in the next few quarters, which will support their higher valuations. Yeah, so that's the wrap up for Mag7. I will present on Nvidia next. So for Nvidia's third quarter results. Next slide, please. Sorry, there's some repeat in contents. But yeah, so if you look at the data center segment, it increased 66% because cloud service providers have been transitioning to ramp up demand in the Blackwell GB300. So the GB300 shipments is actually twice that of GB200 in this quarter itself. So there's a lot of ramp up in this data center segment. And there's also a lot of demand for their Nvidia's networking technology, for example, their NVLink technology, which is being used in the Blackwell GPU racks itself. Yeah, and as you can see in the chart at the bottom left-hand corner, so if we chart out the remaining $380 billion worth of revenue, so that's about on average $76 billion for the next 5 quarters. Yeah, so in terms of scale, that's about a 67% year-on-year increase for each quarter. Of course, it wouldn't be like a linear shape as shown in this graph, but just to illustrate the kind of demand that we are expecting for the next 5 quarters. As for the negative for Nvidia in this quarter itself, the potential H20 sales to China did not materialize this quarter because initially the US government approved the sale of H20 chips, but after that, China's government from Beijing, they did not want to buy the H20 chips itself. Yeah, so currently Nvidia is still undergoing negotiations with China to try to sell their chips to China. But even without these H20 chip sales to China, their Nvidia's data center segment can grow 66% year on year, and we see this as a positive for Nvidia. Our outlook for Nvidia is we do think that the organic demand for Nvidia's chip is still very evident from hyperscalers increasing their capex as well as sovereign countries' demand. For example, as mentioned earlier, South Korea from the EU as well as from the UAE signing deals with for Nvidia's chips. And we think that the risk of circular financing is warranted, but currently it is still immaterial at this point in time. Yeah, so for Nvidia, our call is to maintain buy. We raised our target price to $200 from $185 because we raised our revenue and PATMI for this year because of the ongoing Blackwell GPU ramp. Yeah, next slide, please. Yeah, I'll be presenting on Frencken, the quarter update. Yeah, next slide. Yeah, so for Frencken, overall, their revenue and PATMI is within our expectations. Their 9-month revenue and PATMI is at 73% and 72% of our full year forecast. Yeah, so for the positive for Frencken is that their semicon segment experienced growth because of expansion in Asia operations by their semicon customers. So their major customers is ASML and Applied Materials. And for their medical segment itself, the revenue is being driven by increased customer orders in Asia because of an increase in demand for patient tables by Philips. And the next positive is their industrial automation segment. Even though it makes up only a small proportion of their revenue, there is a spike in revenue because of increased orders from Seagate itself, because Seagate is building up capacity for the memory products. Yeah, so that's why there is the 51% increase year on year in revenue. For the negative for Frencken, there's lower customer demand in the analytical life sciences segment because there's some funding cuts for research in the US. Yeah, so that's why the demand for the analytical life sciences products is lower. As for our overall outlook, we think that the semiconductor segment will face temporary demand softness in the next quarter as well as the first half of next year itself because of longer EUV lead times as well as a strong pull-in of demand from China in 2024. Yeah, so in terms of uh Frencken semicon customers revenue outlook, you can see in the chart in the bottom left-hand corner. So the blue color line is ASML and Applied Materials revenue growth itself. They guided a softer revenue growth for the next quarter. And we do think that this trend will continue because of the of because for ASML itself, as they transition from low NA EUV to high NA EUV, the lead time is longer than expected. So we think that the actual ramp up of this high NA EUV will start to come in at the second half of next year itself. Yeah, so overall, we think that second half of next year, Frencken will also experience higher revenue growth, and also because we do see an acceleration in wafer fab equipment spending in the second half of next year itself. Yeah, so overall, that's why we are positive on Frencken. We raise our target price to 1.87 by rolling over our valuations. And we also think that Frencken is undervalued as compared to its semiconductor peers, and it is trading at an attractive valuation of 16 times PE as compared to its peers average of 34 times PE. Yeah, so that's all from my end. I'll hand over the time to Hashim. Thanks.
Thanks, Iqban. I'll be going through SIA's 1H26 results. Next slide. So SIA registered a 2% increase in revenue year on year to about 9.6 billion. Operating profit was up about 1% to 803 million. So this was mainly driven by their passenger flight performance, where a number of passengers carried by SIA and Scoot increased 6 and 12%. Fuel costs has dropped, which has helped with the operating performance, but this was moderated by an increase in non-fuel costs, mainly from depreciation and handling charges. SIA also proposed a special dividend of 10 cents per share, payable for 3 financial years. It will also pay out ordinary dividend of 5 cents per share. By end of this December, total dividends of 8 cents per share will be paid out. So 5 cents ordinary dividend and 3 cents from the special dividend package. So negative wise, SIA had a larger than expected loss from associates amounting to about 375 million. So SIA did say that the whole 375 million is not from Air India, but a large portion of it is. And Air India has been facing multiple headwinds, which has led to the loss. So first, they had cut down about 15% of international wide body flights and about 5% of narrow body jet routes after the AI 171 accident. So they have reduced their frequency of flights. They also took longer routes to Europe and America after Pakistan closed their airspace to India. So a longer flight route meant higher operating costs for them. The rupee has also hit all-time lows against the US dollar, and Q1 and Q2 are seen as seasons with weaker aviation demand in India. So collectively, all of these drove substantial losses for Air India. Outlook-wise, passenger demand is strong, but passenger yields are under pressure. Scoot passenger yield fell about 6.3% year on year, and this is because they are operating new routes which they have to cut prices on to gain market share. And Scoot is also facing aggressive pricing pressure from regional low-cost carriers. Cargo segment-wise, cargo yield has fallen. Data from October shows that cargo load factor for all regions has dropped, with the largest fall in West Asia and Africa. So these global freighter companies are diverting their capacity away from the US to these markets, which have increased the competition for SIA. So Air India is currently in the third year of their 5-year transformation program. So far, they have added new aircrafts, they have added new routes, and have also been doing fleet retrofits. Despite this cost, airline has been improving operationally. Their load factor is about 86%, and their revenue is increasing 25% year on year in FY24. So SIA is the only foreign company with strong direct presence in the India, Southeast Asia market through its direct exposure to Air India. They have emphasized that this investment is a long-term play for them. We personally think there will be continued losses from their associates in the short to medium term. But in the long term, their investment would pay off if they are able to capture market share in one of the fastest growing aviation market. So our view on the stock is that SIA's core operating performance is in line with peers. Their return on equity, which is an important metric for price to book value valuation. It's on the higher end of the peer multiple for the past few years. Their operating statistics also show that they are performing better than peers in unit cost and passenger load factors. The Air India associate, it's growing top line, and it has also resumed full operations from 1st October after the voluntary safety pause. So we expect losses to taper down gradually. So because of this, we believe SIA deserves to trade at least on par with peers and still lower than their current price to book value. So we upgrade our call to neutral with a higher target price of $6.04. Next slide. So I'll be going through Darren's slide on REITs monthly as he's away on a meeting. Next slide. So REITs have been performing strong with strongest performance in Singapore commercial. So very strong retail and office assets like CICT and Suntec REIT. Their year-to-date performance increased about 20+%, and their REIT index overall is up about 11%. Next slide. So this is their dividend yield spread, which is how much investors are being compensated for investing in REITs minus the 10-year Singapore government bond yield. So it's the incremental yield you're getting for investing in REITs above the risk-free rate. So right now it's trading slightly below historical average, about 3.6%. At this level, we think the yield spread will continue to widen from interest rates coming down. So the absolute DPU will increase, and the 10-year government bond will continue to decline with the interest rates coming down. This will likely widen going forward. We've already seen a lot of REITs already benefiting from the 3-month SORA falling to 1.3%. So over 60% of the REITs that we noted have already benefited from the lower interest rate cuts, as these interest rates have fallen from their peak. The REITs benefited from lower financing costs in the range of about 10 to 50 basis points. Next slide. So for the forward yield, it's fallen because of the recent share price performance. Going forward, we expect forward yield to taper up. Now it's about 5.5%, about 1.2 standard deviation below the mean. And price to NAV, because of the recent share price performance, continues to improve. Going forward, we think the outlook is still positive, especially with the interest rate cuts. With the 3-month SORA at 1.3%, it continues to flow through, and the REITs will benefit more from that. The potential for DPU growth is high, and we think at these levels, it's still attractive to enter into REITs. Next slide. So for retail, performance is strong. This quarter, we saw tenant sales increase about 2 to 5%. Occupancy costs remain slightly below historical averages with limited new retail supply. Rental reversions are strong at high single digits, and we continue to have a positive outlook for reversions, expected to be about high single digits. Government support such as a CDC and SD60 vouchers have boosted retail, so we continue to have a favorable outlook in this industry. Next slide. So for hospitality, visitor arrivals are up mainly from F1 in October, but RevPAR is down about 13+% as F1 date has shifted from September last year to October this year. So the absence of premium F1 related rates and lower occupancy has led to this fall. But going forward, we still forecast at least a low single digit RevPAR increase. We also expect visitor arrivals to reach about 95% of pre-COVID levels. Next slide. So this is just a snapshot of our coverage. We are neutral on Keppel DC REIT, accumulate on CapitaLand Escort Trust, First REIT, Fraser Centrepoint REIT, and Suntec REIT. We have a buy on Elite UK REIT, Lendlease, OUE REIT, Prime US REIT, and Stonebeck Trust. So with that, I'll hand over my time to Zain.
Thanks, Hashim. Good morning, everyone. go through some of the technicals. Next slide. Yeah, so looking at S&P 500 last week, in terms of the price action, last week we saw a breakdown of this uptrend channel that the index had been trading in since July and August. And on Thursday, the price also retested the 50 SMA, which is the green line you see in the chart, 50 SMA breakdown level as well. And actually closed the week holding support at 100 SMA, which is the blue line. So the 100 SMA is also confirmed with the horizontal support level at 6,555, which was the support formed in September to start October this year. So I think overall for now, we could likely see some form of rebound because the price is actually retested this 100 SMA level as well as the horizontal support. And if you look at in terms of the weekly chart, price also tested the 20 SMA level, which had acted as a key support level during pullbacks, especially last year. So I think this week wise we could see some rebound from these levels and just price doing some range consolidation with resistance around the recent breakdown levels in the 50 SMA. So for now, overall resistance likely to be at 6,640 to 6,750 area, and support is likely to be at 6,430 to 6,550 area. So that's all from me. I have over time to Paul will be going through CDL's results on behalf of Darren.
Yeah, thanks, Dean. So, Darren is at the Far East. I think the Far East event. Yeah. So anyway, City Development came out with a third quarter update. There's hardly any numbers there, just some operational update. Just to give you some highlights. So they did mention that the number of units they sold was 88. But of course, this is nothing compared to the prior year. But all this is lumpy depending on new launches. But the recent 706 unit Zion, they sold 84 at launch. So we should expect some strong numbers coming up in the second half results. The next one is the divestments. So this is the key thing. So CDL has always been cheap, but if you don't narrow the NAV, don't dispose, then it's just a NAV that you can see, but it doesn't, I guess, fill our pockets. But right now they're beginning to sell more and more properties. So they're selling some US multi-family assets. And the next one to watch for is the Quayside Isle, the retail property that they launched for sale. So all this could help drive the share price and narrow the NAV. The one negative is RevPAR, which is basically the hotel business. So that's basically down slightly, but fourth quarter should see a bit of improvement, especially in Singapore, because the F1, as we highlighted before, was delayed to October. So in general, we still like the stock because we like it because the number one, the residential property is still growing strong. We expect some recovery in the RevPAR. And most of the investment properties, I think that was mentioned by Hashim, office and all that, they are performing well with high occupancy and creeping up. And we think there should be some potential special dividend. We downgraded to accumulate mainly because of the share price performance. Next slide. So the next one is Thakral Crop monetizing assets through IPO. So next slide. Okay, so Thakral definitely not an easy stock to understand because they are deemed as a holding company. So even in the revenue line, as you notice here, they actually have some investment gains, which is not usual. I mean, most times investment gains are one-off, but because they consider a investment holding company, the investment gains are there. But you can think of Thakral as sorry, it's not in the slide here, but you can think of Thakral as three large businesses. They have consumer lifestyle, which is what we like because they have beauty products in China. They have products in India, the DJI and Nespresso, and the final one is their property in India and also in India, India and also in Japan. And they have all these investments, which if you take them out, they are actually the underlying business is both zero because the mark-to-market gain of the Gem Life is equivalent to the whole stock. But anyway, sorry to digress. But let me just move on to the earnings was beat our expectations because of the fair value gain in Gem Life, but it's generally in line. So for those who may not be familiar, so Gem Life is a retirement home, which they invested long ago and then it got listed. Yeah. But the problem is that the movement in the share price in Gem Life is going to affect the P&L. So anyway, the positive, they listed another of their investments, this thing called Beauty Tech. They sold part of it and then they recognize some of the gains in the fourth quarter. So you should expect some special dividends coming up. The key one that we're watching is the operationally, which is the other lifestyle, which is in China. They're adding more brands, and in DJI, they do in India. They have the exclusive partnership, exclusive distributorship in India, in the whole of South Asia, but not selling drones, because I think in India they don't allow DJI drones. The next one to watch is Nespresso. So they are the exclusive distributor on Nespresso, but profitability only in 2 years' time. So in terms of the outlook, they are still opening stores. So operationally, things are doing well. This India development will take some time, but these are the kickers to the NAV. So we just like it because they have a strong consumer business and it's cheap. Because if you strip out the gem life mark-to-market valuations. Next slide. Move on to Telechoice. So Telechoice, the earnings up 568%. Next slide. So let me just dial back a bit because some of may not know what Telechoice does. So Telechoice been listed, I don't know, more than 20 years. So but their key thing is they're owned by ST Telemedia, partly means owned by Temasek. So there are three parts of the business. You will see here. I should put the explanation. But anyway, PCS is technically phone distribution. ICT is like IT products, IT services, system integration, and NES is network. So they will install network equipment for telcos in Singapore and also in Indonesia. So the 9 months was above our expectations, especially the profit. The earnings jumped. Of course, this is because just to dial back again, they secured a U Mobile. That means the mobile operator in Malaysia that got the 5G license. They provide all the 4PL. So basically, they manage all the phones, distribution, logistics, delivery, quantity, purchasing, everything, and they will earn a service on it. So this contract is worth 500 million. And the other thing was the turnaround the ICT business, which from minus 200,000 loss to 1.1 million profit. So the positive is there's growth in all segments, not just the PCS. So the management is actually starting to turn around because they had the new CEO, I think, a few 2-3 years ago. And the negative is there's some initial drag from investment. So actually the results could have been better because their PCS, which is phone distribution, had a bit of loss in Singapore because they were taking on the new Honor contracts. So when you take on a new distributorship to get into new telco distribution outlets, you have to maybe pay a bit more in the beginning. And their Indonesian network installation, which is installing communications in building in a mall or even installing installing base stations, they recruited almost 4,000 employees. So that initially you get a bit of the drag in the earnings. So we maintain our recommendation. The volume is very thin for this, but we just think that the 5PL will give you some base load in the earnings. But the key thing to watch is also in the outlook statement, they mentioned that they are exploring opportunities in AI adoption in data centers and increasing cloud demand. So we think this statement is important, especially when they have a parent like ST Telemedia, which is one of the largest data center operators in Asia. Next slide. Next slide. So so in terms of the weekly, so as usual, we will just give some highlights of some of the key macro data. Singapore exports continue to be very strong. In October, it just skyrocketed. But of course, this number is very volatile, not going to be 20% every month. Then in terms of the GDP, we saw the GDP. I think what is more meaningful is that the ministry, I think they raised the GDP for 2025 very significantly, because they usually are quite accurate since so many doctorates there, I guess. They revised it from 2.5 to actually 4% for 2025 GDP. And this kind of within the typo, within the pre-pandemic average, excluding 2019. In the US, we finally got some data out of the US. We have payrolls. The payrolls are stronger than expected, but the thing about payroll numbers from the US now, they always get revised down. So the August payrolls that they announced, I think 2 months ago in September, it was originally 22,000, then they revised it down to a loss of 4,000. So even though it's 119, I'm not sure how much credibility can give to this 119 number because they keep revising it. But the one that worrying the market is also the unemployment rate continues to creep up in the US. So it's the highest since 2017 if you exclude the pandemic. Next slide. Oh, okay, so I'll just give some of our usual weekly tactical views. So we all saw the meltdown in the technology sector. So to just give some context, where are we in this sell down? So the Nasdaq's been down about 7% since the peak, record high in 29. So this is between like Liberation Day 16% collapse, or the 2nd April when Trump announced all those tariffs. It's also it's worse than the DeepSeek and Silicon Valley. So I mean, hard to go and pick a bottom, but we're probably more or less there, I think. Like what Zane mentioned, unless there's more negative news. But we saw one of the triggers to the sell down is, of course, the collapse in Bitcoin. So I think the debate now, not the expert in Bitcoin, but the debate now is that people are considering whether is it still really a store of value because of the huge volatility. And of course, compared to gold, and of course, gold, you have the central banks buying, but Bitcoin, you have maybe MicroStrategy buying. And the other thing that's worrying the Bitcoin investors is that, or speculators, maybe, is the medium of payment, because with the Genius Act, which basically legalize kind of stable coins. So the debate now is whether Bitcoin, is it even useful as a medium of payment? That means transferring money, since I can transfer with stable coins and that is like backed legally and with treasuries. So again, all this comes up when there's a sell down in Bitcoin, but yeah, anyway, just for info purposes. But in terms of Singapore, we had actually very good news. We have, of course, the economy is strengthening with a huge revision by the authorities in their forecast of 25. So there is upside to the Sing dollar, because usually when the economy is tightening, they might actually raise the appreciation. I mean, it won't be good for equities, because a lot of the investors have a lot of like REITs and companies all have investments overseas. But I guess good for us as tourists. The other positive news is the second batch of EQDP. The first batch was 1.1 billion, which we think at most only half has been used. And the second batch is now double or almost triple that, 2.85 billion. So for us, we think the recent weakness is a buying opportunity, because, before the liquidity and momentum build back up for small and mid-cap stocks, I think we will see the momentum because the money will come in. But, small mid-cap stocks, everybody just chase momentum. But I think for us, we just saying that just get ready for the momentum to come in, since there's money coming in. In terms of interest rates, it's still 50-50 whether there'll be a rate cut in December. I think the odds was not supposed to be so high, but I think right now, because John Williams, the most important Fed official after Jerome Powell, mentioned that there's actually room to adjust in the near term. The two reasons now why there should be a rate cut, which is our base case, is that the labor market is weak, like we mentioned, unemployment rate is rising. And also, we'll show you another data point later. But the other thing is that even if they do cut, I think John Williams' point is that they are cutting into neutral. That means they are not easing monetary policy. So even though they cut, it doesn't mean the interest rates are easing. Right now it's very tight in their mind, and then this is just turning monetary policy to neutral. That means like turning interest rates to neutral level. These are some of the key events. We got Alibaba, we got the core PCE. So this important metric. This will decide if it's within expectation, it's fine. But if it's too high or too low, then it might affect where the interest rates will be. Core PCE price is what the Fed uses to their so-called 2% target. This is the metric that they use. We got 4 more events to end the day. So these are corporate insights. It's open to anyone. So you want to know more about the US REITs or the US office market, do dial in for Manulife. Soon Hawk is the new IPO. I think we heard Marco Polo most should know. Yeah. Marco Polo just gave a upbeat earnings forecast. Next slide. Okay, these are just some charts. So you notice that on paper right now, payroll seems to be improving, but again, a bit skeptical on these payroll numbers because but there's always revision risk. So the next one is if you look at the red line, so this unemployment rate is starting to creep up. It is worse than pre-pandemic, which is 3.5. And the blue line here is think of it like demand supply of payrolls. So it is basically vacancy. That means the amount of jobs up there, demand, and compared to supply, which is the unemployed. So it used to be more demand, that means more vacancies. Now it's starting to be equal. And of course, even below the 1.2, which is the pre-pandemic. So the payroll, the job market is weakening. I mean, you look at all these various data points. Next slide. Oh yeah, okay. Anyway, this is my second last slide. Sorry. So our Phillip on the ground. So First Resources is a palm oil company. The earnings was up 35 because they included acquisitions. They acquired an Indonesian. If you strip that out, I think probably they will be up like 20-30%. Okay, but I mean, let me just give you some key highlights why we thought this was important just to highlight. So the key thing that is everyone is watching for palm oil is the B50. So if Indonesia goes to B50 by middle of next year, then if you look at the second bullet point, it's going to be very positive for palm oil because there'll be additional 3 million tons needed. So demand will just suddenly shoot up because they need the B50. I'll just go on to the last comment. So actually right now there's a lot of political risks around all these Indonesian plantation companies, like something like Wilmar, because there's a lot of moving parts now for palm oil sector for those plantation companies in Indonesia. So the number one is the penalty on the forfeited plantation land. So bear with it, it's a bit long story, but if you recall, for a couple of months ago, the Indonesian government took back some of this plantation land. They said illegal, and they came up with a presidential decree that if you have to pay 25 million times number of years you held it, it's roughly about $40,000 per hectare. The rumor there is about 1 million hectares, so you're talking about 40 billion penalty. Again, I'm not saying this is the amount, but this is the rumor. So this could be a big hit to a lot of the Indonesian plantation companies if this is infected. Okay, so that's the first political issue. The second unknown is the clawback. So there's also talk that all those earlier biodiesel plant companies that actually make a lot of money, $100 per metric ton, there's a bit too much, the government wants to claw back. So this is also another issue. Then the third one is if you read the New Nation, there's this thing called the patriotic bond. So it's not really an issue, but I think some plantation companies probably going to subscribe to this patriotic bond where it pays an interest rate of 2%. This is really not negative, but I guess, the interest rate is a bit low here. Yeah. So, I'm just highlighting some of the political murmurings around all these Indonesian companies, which will be negative for Wilmar, of course. Next slide. Okay, sorry, it's a bit small here. We try to expand it a bit, but this is just our Phillip. We call it the hit list. It's just a name. Just the small mid-cap stocks below 1 billion, which is under our coverage, which we separate it by sectors and target price. We will add more columns in the future because this is from our reports. Okay, I think I can move on to Q&A.
Let me take on some first. Yeah, there's a few on the Mag7, so I think they're asking which are our top picks. Yeah, I'll leave it to the rest of the team because they I cover Tesla and it's a sell, so I don't think it's probably the last pick if you think about the Mag7. Yeah, so if you're interested in that, I can go into more detail. But if you're looking to accumulate, I think I'll leave it to the rest. You can look at names like Alphabet, Amazon, Nvidia, Microsoft. Yeah, so these will be the names that I think are more like we see more growth in those names. Yeah. So I'll leave it to the rest of my colleagues for that. And then I think I'll take on the one on the banks. Let me try to find a bank question. Yeah, any thoughts on strategy for Singapore banks going forward after recent share price pullbacks? Still makes sense to buy on a dip, and is UOB still preferred counter? Yeah, UOB has not been our preferred counter for I think almost the last 1 or 2 years already, right? For multiple reasons. Even before they had this preemptive general provisions, right? The 600+ million, right? It was never really on our preferred list, mainly because they firstly they don't they like to put on a lot of provisions so that they don't give any indication of releasing it. And secondly, also, if you compare their dividend policy, to DBS, for example, right, it is really quite lacking, and they're not giving much insight into how much they'll be giving back. So that's the main reason why it's not hasn't really been our preferred counter for quite a while. So, you look at for the strategy moving forward, yeah, I think there's some, share price pullback is really, I guess it's a bit of a profit taking because the share price did run up, especially for DBS. But, for Singapore banks, like I've mentioned, last week and I think the week before as well, is that we will see some moderation in their earnings growth. Even I guess the one that has the strongest growth, DBS, we still see, earnings, the bottom line will be pretty flat going into next year and for the end of the year as well. Really, it's from the rates, the continuous decline in rates, which will affect their loan yields, but they will be trying to offset this with some form of cuts in their deposit rates, right? So their cost of funds will help to offset some of this decline in the loan yields. And also loans growth has been very healthy, so that will help to offset that, and also fee income growth. So the bank that we are looking at that will perform the best will be those that can take advantage, firstly, of their deposits, and how they play around with the hedges, and where they put the money in, and also how well can they grow their fee income to offset the decline in their margins, right? And that would be DBS, right? And on top of that, DBS also has the clearest dividend policy, right? They are giving absolute dividend per share guidance, not just dividend payout ratio. So it's very easy to see when you enter, and how much dividend yield you'll be getting for all the way until 2027, right? If you look at most recent share price, right? We are forecasting a dividend yield of around 6.1 to I think 6.2% for FY26. Right, and that's if you enter in now at the current share price. So that's very healthy, and only with DBS then we can be very certain that will be what they'll be giving, because they give absolute dividend guidance. Hold on, the question just jumped up. Let me try to find it. Yeah, so that's what our pick is for the banks. I think there's one more question that came in. If UOB has included a huge provision in the recent third quarter earnings, perhaps there should be less provision going forward and tailwind for share price appreciation. Yeah, that's an excellent question. That's what we think we assume would happen, but we didn't really. Firstly, it came a bit of a surprise, right, that they will be doing this provisioning currently in the third quarter, and that they will do such a huge sum, right? That it's not split up among different quarters, right? That they will at least moderate it out slightly. And the reason they gave is because their NPA coverage is quite low. So if you compare NPA coverage wise, it's still the lowest amongst the three banks. They're only around 100%. You look at DBS, it's 130 plus, and then OCBC is 160. So there's no promises given, right, by the UOB management, or even we can't really say that since they already put on this much, that they're gonna there's no possibility of them putting on more. The reason that they give is because valuations are quite weak for their US properties, so that's the reason why they put on so much provisions. So if valuations do decline further, then there is no end to see whether or not they will put on more. And why we choose DBS as well is because they also have a huge sum of management overlay, 2.5 billion, that they have indicated very explicitly that they might have GP write-backs of this, and this will just help to improve the earnings. The other two banks, they don't mention firstly how much they have in management overlay, and secondly, there's also no indication that they will have any write-backs if conditions improve. So that it's really a lot of it's a bit more risky because a lot of guesswork with the other two banks. But with DBS, it's a lot clearer. I think that's why they have performed better, is because they're very clear on where they will be going forward with what they have. So that's the main reason why, firstly, their share price has gone up a bit more significantly than the rest, and also why we like them a lot better than the other two. Yeah. Suddenly a whole bunch of bank questions that came in. Yeah, other than DPS, which would be preferred, OCBC or UOB? I would say OCBC because OCBC would be our second pick. Really because of their fee income, and their insurance arm is doing a lot better. So if you look, compare side by side, they're very similar dividend policy wise. But the fact that OCBC is generally more their MPA coverage is better, so we don't really see signs of them putting on a lot more provisions. They actually did write back a bit in the most recent quarter, right? And also, if you look at their fee income growth and their insurance arm growth, it's also quite strong. Their clients are more they're leaning towards more of putting a lot of their money to work into investment products. Whereas UOB, it's a bit of like a stagnant. They're growing, like very low single digit or like even a small decline. So their fee income wise is not doing as well, which doesn't help to offset that decline in the margins. So I'll say OCBC would be second, after DBS. Oh wait, sorry, jumped again. Yeah, do you see any shifts in DBS's strategic direction after Sushan took over from Piyush? Can he continue to remain excellent blue chip Singapore stock that delivers great shareholder returns? Yeah, definitely. I don't think we have seen any shift in the strategic direction after she took over. Yeah, she has been, I would say, groomed to take over this role for many years already. Right? She was under his wing for a long time. So I don't think she will not suddenly take on and then change things. Yeah, so I believe that they will continue to remain this excellent blue chip Singapore stock. Yeah, I'll continue. Will SGX stock benefit from the latest round of EQDP news? Yeah, it should, right? That's the whole reason. It will definitely improve because volumes will increase, and it should definitely improve. So that's the question. Of the three banks, UOB seems to have the best valuation or undervalued, and dividend yield not too bad despite uncertainty. Yeah, for sure. Because their share price has declined so much, right? So if you think about it, if the share price go down, the valuation is good. It seems to be well. And dividend also will go up, right? Because if you look at the share price, then dividend yield is based on the share price. So yeah, but it's again like what I mentioned multiple times. It's very uncertain whether or not they will put on more provisions because the MPA coverage is really the lowest, and also they are not given any indication on where they will be spending extra capital, right? It will probably end. They'll only continue to do their share buybacks. So very similar to OCBC, there's no outlook or guidance on that. Will GE continue to be a good contribution to OCBC earnings going forward? Yeah, we believe so. I mean, the only thing that we probably see, some negativity is because they didn't privatize it, so it doesn't fit as well into their one group plan. But overall, I believe that they have a lot more clarity now where to go, and also we must look at their CEO handover, right? They are changing their leadership, so there will be I guess some change, but I don't think like similar with when Sushan took over Piyush. They have been groomed to do this. It's not like there has been any the new CEO is not in OCBC for quite a while already. So I don't think there'll be much difference. Yeah, not sure about this question. Is this GE no trading today? Yeah, I don't really know more about that. Yeah, okay. I think that's all for me. Yeah. For all my questions. I'll hand it over to the rest of the US team to answer some of the US questions. Thanks.
Yeah, thanks, Glenn. I can try to take on the Mag7 counters question. So I think out of the Mag7, Nvidia is the fastest growing one. So its revenue growth is like 62% year on year. I think the second fastest Mag7 growth is about 20+% year on year. I think it was Meta. Yeah, so I think if you want the kind of fastest growth company, then you can consider Nvidia. But currently, based on forward PE, Nvidia is still trading at a premium compared to the other Mag7. So in terms of forward PE, Amazon and Google has one of the lowest forward PE of about 25 times forward PE. Yeah, hopefully that gives some insights. I think I'll just leave the question here if any of my colleagues want to add on. Next question, WeHer and Centurion, my outlook on this and its target price. Any views on the weakening current price trend? Yeah, I think for WeHer, my outlook hasn't changed. Their recurring income is still coming from construction and worker accommodations. And recently they had some announcements. For example, they are going to build the Wycombe Abbey School, which is an international school, as well as they are going to set up the DoubleTree by Hilton Hotel. Yeah, so I believe that these two projects will add on to their construction order book, which will boost the construction segment revenue. But from the, I mean, they haven't disclosed any financials, so can't really pinpoint how much will these projects add on. And recently they also won the Upper Thomson GLS site, which I think it will add on to their Singapore property development revenue. But I think it will take at least like 2-3 years before the revenue start to kick in. Yeah. I think for WeHer, we'll need to keep a lookout for whether the lease for their worker dormitory, the Tuasville dormitory can be extended, because that's a 10,000 plus dormitory, 10,000 plus bed dormitory, which will expire next year November. But I think that my personal take is that the BCA will not they will extend the lease. My take is that they will extend the lease, because I don't think that right now, as Singapore is going through a shortage of worker dormitory, I don't think they will just discontinue the lease and have a 10,000 bed shortage in Singapore in terms of the construction scene, because the workers still need a place to stay. Yeah, so that's my take on WeHer. For Centron, so after they do the REIT spin-off, I think there has been some weakness in the price. Maybe some shareholders may be selling the stock itself to buy the REIT itself. But I think for Centron, the balance sheet is very strong now, because it has become more asset-like. Their net debt decreased by 89%. So right now their net debt is about 70 million, compared to previously it was 500 plus million. And they also had a much more visible expansion pipeline. So going forward, we do see some Melbourne PBSA coming up, which will add about 70% bed capacity to their Australia PBSA beds, as well as and they are also going into a new segment, which is to help manage worker dormitories. So we think that will bring a bigger margin to their business itself. Yeah, so overall for Centron, we are still positive. There's also the dividend in specie upcoming for Centron shareholders, which we think will yield about 7.5% after next year's AGM. Yeah, so overall for Centron, we are still positive. Yeah. There's a question: if Microsoft and other hyperscalers decide to use in-house chips, will this spell trouble for Nvidia, AMD with downsides on their future revenue and earnings growth? So just some context for the in-house chips that Microsoft, Google, Amazon that they design, right? These chips are application specific chips. So which means that once they are designed, they can only be used for this particular application. For example, for Meta, maybe they want to design a chip that is specific for ad recommendation. Maybe for Google, they may want to design a chip that's specific for like the recommendation system in their YouTube. So once these chips are being designed, they cannot be used for other purposes. Yeah. So I don't think that just because they decide to use in-house chips, the demand for Nvidia and AMD's chips will drop. Because Nvidia and AMD's chips, they are more general purpose, which means that if the hyperscalers want to change the use case for their chips, for example, from LLM, they want to change it to a new AI technology, maybe like physical robots or driverless cars, they can immediately change their chips to do, the general purpose chips to do so. Yeah. So I don't think that it will cause a drop in terms of demand for Nvidia and AMD's chips. Yeah. On Nvidia, do you note that both inventory and receivables are increasing? What does this mean? Yeah, so for inventory, there's I think about more than 2 times increase year on year. I think that this is because they are preparing to to launch the Rubin GPU next year, second half. Yeah, so second half there's a new Vera Rubin GPU. That's the next generation GPU after Blackwell. So I think that they are increasing the inventory to prepare for that. Receivables increasing, I think it's just a matter of timing. The receivables increased about 88% year on year compared to revenue. Revenue increased 62% year on year. So I think it's not a worrying sign because the revenue is still experiencing very strong growth and Nvidia has a strong product cadence going forward. Yeah, so I think it's just a matter of timing. Yeah. Advice outlook for Celestica. Yeah, so I don't cover Celestica. So I mean we don't cover Celestica, but I think generally they are sort of like a contract manufacturer to design rack solutions for memory chips as well as for high end chips. Yeah, so overall the I mean overall industry wise, because of the data center build up from sovereign nations as well as from hyperscalers, I think it will benefit this company, even though I haven't went into the specifics. Yeah. What's your view on central accommodation REIT? It has outperformed the REIT market. Yeah. Yeah, I think it holds very high quality assets, Singapore worker accommodations, which is still experiencing shortage because of the I mean many major construction projects that are upcoming in Singapore. So I do think that rental revisions can still happen, even though at a more moderate pace going forward. Yeah. Yeah. In terms of outperformance of the REIT market, yeah, I think we'll have to check more on the valuations, but right now it is about a 1.2 times price to book value lah. Yeah, so it is on the slightly premium end. But I think going forward, I think I'm still positive on the assets that it is holding. Yeah. Is there truth in Michael Burry's claims against Nvidia and AI? Yeah, so just some context. What his claims is about is in terms of the depreciation of Nvidia's GPU lah. So basically, he's saying that hyperscalers are overstating their profit because in terms of depreciation wise, hyperscalers will stretch out the depreciation cost across like many years, 5 to 6 years. But he claims that in actual fact, the GPU can only be used in a much shorter time frame, maybe 2 to 3 years. So that's why he thinks that the hyperscalers are overstating their profits. But however, in Nvidia's earnings call, Nvidia CEO did clarify these depreciation claims, and he mentioned that the previous generation Ampere GPU, which is being released 6 years ago, right? It is still in full utilization now. So Nvidia CEO is trying to say that the Nvidia GPU can be used for 5 to 6 years. And this is because Nvidia has a very strong CUDA software ecosystem. So this software ecosystem can support the older generation of GPU being used. Yeah. So I think there may be some truth, but right now it is still not worrying. Yeah. Why BRC results weak? Yeah, I think if you just look at the bottom line results, it may seem that the profits have dropped 5%, but that is because last year, second half itself, BRC Asia experienced a 60 million profit gain from disposing its associates. Yeah, so if you strip that out itself, the adjusted net profit is about 30% year on year gain. Yeah, so I think that BRC Asia's results is quite strong this time. We are meeting management at the end of this week, so any updates will be posted like after the meeting itself. Yeah, so just keep a lookout for that. Thanks. Is market chatter about Nvidia being able to sell H200 insignificant in terms of revenue? I think right now is still at a very early stage. there's many hurdles to cross. For example, you have to go through the US government issuing license first. Then after that, China government has to want to be able to buy the chip itself. So if you just assume there's no China revenue, uh, the outlook is still strong for Nvidia. There's still at least a 65% year-on-year increase for the next few quarters. Yeah. Yeah, I think right now I'll just hand over to my other colleagues. Thanks.
Okay. I guess I want to add on a little bit about the hyperscalers building their in-house chips. So the rationale that most of the hyperscalers they even try to bother to develop their in-house chips is because Nvidia's supply cannot really meet the world demand and the AI workload are exploding. So for them, they really want more bargaining power when it comes to Nvidia. So for them, if they can get their hands on as many H200 Blackwell GPU as they wanted, they probably wouldn't even bother making their own internal chips. So the internal chip is really more of it's not like a replacement for them, it's more like a supplement. So what it usually works is they try to develop an internal chips for more specific narrow workload, but they try to use NVIDIA and AMD's chips for every heavy training or general purpose acceleration workload. So in the short run, definitely they're not going to be able to keep up with NVIDIA. So in terms of competition, so it's more like a supplement use. So I hope that clears. Then I guess I'll add on more on the Magnificent Seven and which counters we recommend. Because I cover Amazon, I think I can speak for all the cloud industry players. So we're still pretty positive on the entire cloud industry. This we take a look at Amazon, Google, or Microsoft. So all of them are actually seeing very strong backlog. So for Amazon itself, the third quarter backlog that they are seeing, backlog means the deal that already confirmed they haven't really delivered yet, is actually exceeding all the third quarter revenue that they have since the beginning of AWS to now. All the third quarter adding up together is less than the backlog that they're getting for the most recent third quarter. So that kind of shows the amount of demand that is coming in. And all these three hyperscalers, they're still spending a lot on their capex because they're seeing the demand coming in. So for them, it's more of a competition of who can keep up, who is able to cater to the blooming demand that is coming in. So it's still a very positive sector. So yeah, I hope that answers your question. And I saw another questions jumping a little bit. So there was another one. I can't find the question, but basically it was asking why the ones that were recommended, they're not really performing, but stocks like Apple, they don't seem to have a very good prospect, but it's soaring. Because for Apple, like I explained, it's really because they're seeing really strong demand for the iPhone 17. But so in the short term, so people seeing it as very positive, but we really, in the long term, we still don't see it as a revolutionary change that is going to really spur the next super cycle for iPhone. So so even though Apple is doing great right now, they're coming up with guidance that's higher than ever, but still we're pretty cautious because we don't really see like a very long-term push for the stock. While the others, I think I guess I'll let Serena to add on more. I think because right now a lot of the stages they're still heavy in the investment stage, because of the people's fear of AI bubble and like whether investment is too much investment. So that kind of caused a lot of unsureness between people. So I guess I'll let Serena to add on more. And there was another one about something Amazon, whether it was the Magnificent Seven Amazon. Yes, because that was actually a wholly owned subsidiary of Amazon. So yeah, I guess that's all the question I have. I'll pass my time to my colleagues to add on more.
I think I'll answer some of the questions. Yeah, there's a question says that why Google doing so well despite market bad, but Meta tank. Yeah, thanks for the question. I think Alphabet share price is doing well because around this AI competition, they're actually showing that they can actually integrate this AI thing in with their product and actually manage to monetize it as well. I mean, after all the hyperscalers spending so many money on AI, I do believe that investor wants to see whether there is really a ROI on this, and then based on the results, Alphabet actually managed to monetize it. So at the beginning, that there may be some of the concerns about competition from ChatGPT, but Alphabet's result, like I mentioned, they are competitive enough to. It shows that they're competitive enough to actually retain user and also growing user in Gemini. And secondly, is that they in the ad business they still managed to make sure that advertiser spending are actually increasing. And at the same time, Alphabet actually has a more diversified revenue stream, which is besides having in ads, they also have a cloud business. And cloud business overall momentum is still very strong because of the enterprises demand. But besides the demand for their data center, currently we actually also do see that because they develop a deeper relationship with their existing cloud clients, it's not just the data center demand, they also service demand, AI solution demand as well. So based on the reason number, around 70% of them are actually adopting a Google Gen AI product in this, which includes like Gemini and also like Imagine, which helps to convert like image to text, this kind of AI solution products. And then in this particular area, because of the very high adoption, it actually helps with the revenue growth of over 200% year on year. And the last thing I think the advantage for Alphabet is that because they are the full stack AI provider, so from chips to LLM, they are actually building it in house basis. So it actually helps like makes them less reliant on other company, and they have more control on the efficiency. And then regarding to the Meta, I actually do still believe that their fundamental is still very strong. The important key metrics that we are monitoring right now includes like user screen time is still up 5% even for Facebook and Instagram. And secondly, advertisers demand still very remain very strong. They are still managed to to let advertisers to spend more money on their platform is up 10% year on year. We think that it could implies the ad targeting capabilities actually becoming more efficient since they started to integrate AI into their products. And overall, we actually do see that it's becoming a more efficient like social ecosystem when they match the ad business and also business messaging business. But we think that the share price is currently like tanking. Mainly is because of the guidance of the very high capex. I mean, at the moment, yes, we do know that they do want to invest on this super intelligent lab vision, but they haven't really communicated well with how to monetize it. So that I think investors still have a little bit of concern, and this is why we actually have an accumulate rating, means that we still seeing what's the momentum of it, but then overall the fundamental is very strong. But we slowly I do think that investor might want to see some of the return throughout all this earnings call, so that they will start to gain more confidence over the period. Yeah, I hope this. And then I think there's another questions about Meta as well. Yeah, so this is my question is related to Meta as well. So among of the Mag7 stocks, Meta has a highest price appreciation target, and should it be investor top buy? Yeah, like I mentioned it before, I still think that the fundamental is very strong. The current market's concern really is this capex, but I mean overall, since I still think that all of these hyperscaler, they still this investment style still remains quite reasonable. Part of it is because they have a very strong free cash flow that actually manage to cover the investment that they want. And for Meta moving forward, and I think for other hyperscaler as well, they will step into the bond offering in order to fund off the investment as well. So yeah, so far I still think the investment size remain quite reasonable considering that the scale of the company and also how well they're performing in their core business segment. Yeah. Yeah, I think that pretty much it. I'll pass the time to my colleagues. Yeah, I'll turn the camera on again if there's any questions about Meta and Alphabet. Thanks very much.
Thanks, Rina. So I'm going to answer the question on Oracle, right? So someone was asking that the Oracle price is declining very fast. So the first reason of why the price decline is first is vocal because of the market sell-off coming from the market-wide factor that nowadays the people keep saying stretch valuation of the AI-related stock, and in particular, Oracle is heavily affected because their current growth narrative is centered around the cloud infrastructure and AI, right? Which is their growth driver. So that's you include that with the Michael Burry put that is going on at the moment. So people are not looking Oracle in the light at the moment. So market is also discounting Oracle because of the hype that's coming from the previous Oracle price rally. So now they have that coming following the announcement from the cloud services boom that they came down previously. Yeah. Second is because the concern of the high debt that they are taking right now and how they are going to affect their earnings in the near term. So this comes following this. In the last few weeks, they announced that they are taking 56 billion additional debt, right? This from 38 billion in loan and 18 billion in bond sales to support their high capex, all right, in return to support their high order that they receive from the enterprises. So really, the market is just concerned about their Oracle credit quality, all right? Because Oracle is giving 5 years protection top line growth. But what people are wondering at the moment is about the near-term growth of their earnings, because they are worried that they might not even be able to pay off their these high interests coming off from their high amount of debt. So it's about the rising near-term expenses, and the investors are worried whether they can sustain a very high margin, their margin, because when you increase the amount of debt that quickly, the high amount of interest rate could affect your earnings very fast, and it could contract your earnings and all that. There's also then this is very reflected in the recent Oracle CDS, Oracle Credit Swap Derivative Swap, that we see these numbers jump. So meaning that the market is betting against these Oracles to default against their credit quality and even their credit to deteriorate. So really, because this news came out outside of the earnings call, I think there's many speculation about it, and people are taking the worst case scenario. All right, if you see the price decline, people are not looking at it in good light. So the next quarter is coming out in 8 December. So I think this is when the company is going to address how they are going to monetize, how the monetization is going to be following the high amount of debt and interest that they're going to take in the next few years. So we are monitoring on that. So, but we are still positive on Oracle. We think that because they already have the high demand of backlog, and they have the advantage in the market as the main, wouldn't say main, but the rising cloud and AI players. They have the advantage against the regulated industry, things that other hyperscalers won't really do, can't really do as they did. So it's like everything is set up for them. Like the demand is there, they get the advantage and all that, but it's just the monetization issue and how they are going to address this high amount of debt that I personally think that they're going to address it in the next earnings quarter. All right. So that's about the Oracle, I think. And then there's on the Magnificent Seven, which stock, because I covered Microsoft. So for Microsoft, I'm positive on we are still positive on the Microsoft. So the revenue is growing really well, and their cloud services is growing really well as well. And compared to the others companies out there, Microsoft because we are having this turbulence on AI team, right? That AI, they are hedging against AI, but Microsoft is one of the companies that can clearly show that they are generating top line and revenue coming from their artificial intelligence spending, because they could also quantify as well of the percentage of growth that they're having and how much of those are coming from AI. So, and also at the same time, when you look at the business model, they are really defensive that their productivity is used by many enterprises out there, and many of their customers out there are enterprises, right? So I think that what is going on is just sentimentally driven because of AI. But when it comes to Oracle, when it comes to Microsoft, their high capex is well spent, and we could see in their earnings coming growth that we see that the revenue coming from cloud is comparable to the amount of capex that they spend, and they could also quantify the AI that's coming from their top line. So we are still positive on Microsoft because of that issue. We think they are going to be lessly affected from this what we are having right now. Yeah, but although they already were affected, if you look at the price, but we see that the chance for them to rebound is like in the near term, while the others probably might not. So that's for me for Microsoft. Pass over to the next presenter. Sorry, my colleague to answer the Q&A.
I think we hand it to Zain since it's already 12:35. I'll just tap out.
Okay, yeah, thanks for I'll share my screen. Let me share my screen right now for the TA portion. Okay, first one is on Penn United. Yeah, so for Penn U, in terms of the current trend, there's some short-term weakness with the recent, as you can see, when the price broke down below this range consolidation between $1.12 to $1.19, and also this bit of a longer term uptrend support line. So I think in terms of moving averages, also below the 100 SMA for now. And I think for now, in terms of the current momentum, I think we could still see some weakness, perhaps towards a retest of the previous support levels in July to August this year. I think there's a bit more stronger support closer to the 97 cents level to about $1, the psychological level as well. So I think price for now could continue a bit of a pullback to retest this support level, and then probably could do some rebound afterwards. Next one is Frencken. So in terms of Frencken, I think recently price, since the breakdown of this price was just moving sideways in the first half of November. Then afterwards, there was a breakdown below this 157 support level. Afterwards, price just pulled back. So I think for now, most likely could see a pullback to retest this 138 horizontal support level again. Then perhaps most likely, my guess would just be a bit of a sideways that we've seen in like August to October this year, where price just moving sideways between 139 to 146. Yeah. Okay, I see there's a question by Steve in the chat. Any sharing on USTA tonight? Yeah, there's a TA session ongoing, 8 p.m. to 9:15 p.m. tonight. So if any questions on TA, you can feel free to join in tonight. Yeah, thanks. Then next one is a Hong Kong counter 778. Fortune REIT. So for Fortune REIT, I think overall in terms of the longer term trend is still in the uptrend since like May this year. May of last year. Then currently I think it's just a sideways consolidation with some slight weakness where price still unable to break above this 524 double top for now, and a recent breakdown below this 498 horizontal support level. So I think for now, short term wise, maybe could still see some pullback towards like this 477 level again. Then could just rebound and consolidate sideways between 477 to 498 for now. Then there's a question on TA and FA for Manulife USV. I'll talk about the TA portion. So for Manulife, if you look at terms of the chart, it's just been consolidating sideways, but I see there's some weakness for now, where price has been retesting the support level at 0.07 to about 0.071 with recently lower highs up, with lower highs formed since middle of September this year. So I think that shows price weakness in terms of also currently below like the 50 SMA level and currently at the 100 to 200 SMA level. So I think for now, if there's a breakdown below this 0.07 level, we could see some further pullback towards the next key level will be around 0.065, around there. Next question is on Palantir. What's the price to buy for Palantir in terms of TA? Yeah, so in terms of TA, I think for Palantir is deep quite a bit. Currently as of like last Friday's the intraday low was like close to 147, 148. So I think this was quite close to previous support level formed in like August this year. And we see previously there has been some lower wicks over here previously, like 143 to 150 around this area. I think it hit this support level over here already. Price might probably do a bit of rebound, but I think if it goes a bit lower, the 200 SMA, which is currently this purple line that you see in the chart, close to 140, I think there's probably some support level over there. Because if you look in terms of if I zoom out the chart, the price actually hasn't tested this level since quite long, like August of last year. So I think if it actually does retest this level, it might be a good short-term buying price in terms of technicals. Then switching in terms of weekly, also I think just now I was looking at it on the 30 SMA weekly. I think it's also previously a support level in April this year during the April sell-off, and currently back to retest this level. So I think for now over here, I think might be a better entry price. Yeah. If there's still some weakness over here for now, then yeah, that's for Palantir. Next one on moving back to some of the Singapore counters, Semco Industries. Yeah, so for Semco, I think not for now. Price has faced a bit of resistance at this 664 level from this rebound. The rebound from the August lows found some resistance at 664, and currently I think price is showing some weakness again, where there's some we see some pullbacks on high volume, and then the rebound and lower highs, and then recently also another sell down in terms of with high volume again. With looks like it's break below this 620 support level as well. So I think overall in the short term wise, I do think there could be still some short term price weakness to most likely retest this 596 horizontal support level again. In terms of weekly, also not looking very good. Previously, where price was trying to hold sideways along the 10 SMA weekly, but last week it broke down with high volume. So I think we could see some price weakness downwards if it fails to recover above 620 with high volume. Next one is SETS. Okay, so SETS, I think there's a bit of slight weakening in terms of the trend. So it was moving sideways with some resistance at 352, which was a previous resistance level back then, and moving sideways with support at around 335, 337 around there. But some weakness where I think price has been testing this support a few times, and then there's a potential breakdown of this short-term uptrend support line as well, together with this horizontal support. So I think if price continues to remain below around like 338 for consecutive days and unable to reclaim back this 5 MA, this short-term MA, we might see some continuous to retest some of the lower support levels like 330 to about 322 and 330 over here. Yeah, so that's some of the potential next support levels. I think, yeah, for now, price looks like it's showing a bit of a slight weakness if it continues to hold below 338. Next one is SIA Engineering. Yeah, so for SIA Engineering, I think overall it has been still a very strong uptrend in terms of the charts. I think most the key resistance is along this trend line over here. Then just been doing some slight pullbacks along the way. I think for now, the recent pullback has brought it back down to about 360, which is a retest of this range breakout level in start of November this year. So I think there could be some bounce that comes in from this level over here. Yeah, in terms of the weekly, I think also retested the 5MA weekly as well. So probably there could be some bounce that comes in along the way. And I think overall has been the share price trend also demonstrated by its on the weekly is remaining along the 10 SMA weekly, which is currently around 354. I think it's still there's still some strength in the chart, and we could see a bounce from this retest. Next one, Singtel, another strong counter. So for Singtel, still around close to the all-time highs, and it's just moving sideways for now. Since the breakout of 464 and some resistance around 483, 484 for now. Overall, still okay. Recent supports in terms of the lower wicks is found around 472, and around the 10 MA is still holding at 10 MA is still holding at support. So I think as long as this level at 472 over here still holding at support, I think we could most likely still see the trend continue to go upwards. Yeah. And next one is on WeHe. Yeah, so for WeHe, I think in terms of the chart, also some weakness since the breakdown of this short-term uptrend channel. Price has been showing weakness with lower highs, and then also recently there's also a breakdown of this 70 cents, like 71 cents support level over here again. So I think we could see some continued share price weakness in the near term to retest some of the lower support levels. I think around 65 cents there was a swing low here, and also there's a swing low here around 67 cents. So next support area probably around 65 to 67 cents area. Yeah, in terms of weekly wise, also currently below the 5, 10, 20 SMA levels. Yeah. Okay, next one on Q&M. So I think Q&M overall, it's still a very nice uptrend over here. It's rather volatile as the trend channel is quite wide. So I think currently it's pulling back from this. It has been pulling back since start of November. This from the channel resistance. And some recent weakness is when there's a breakdown below this 50.5 cent level, which was this resistance. So it held as support for a while, but price was unable to demonstrate strength and continue to trend downwards along the short-term moving averages as well. So I feel that for Q&M in the short term wise, I'm expecting a bit of a further pullback towards 47 cents to 47.5 cents area, where this was a horizontal level as well as the channel support over here. So it might pull back to this level and do some slight rebound, but for now. But I think for it to regain back some strength, it could possibly need to do something like did previously over here. During the pullbacks, it tends to find resistance from this like a short-term trendline resistance. Then afterwards, when there's a breakout, then we see the share price rally. Yeah, so I think we might be seeing something like this again. Yeah, there's another trendline resistance over here. Yeah, I'll move on to some of the other questions. STI, local banks. Yeah, so for STI, I think overall, despite the recent market weakness, we can see strength in the STI where it's just pulling back slightly from the all-time highs and retesting this breakout level at the beginning of this month at around 4,475 points around there. So I think for now it's holding support. So I think we could expect some bounce in short-term resistance. I think maybe around the 10 MA, around 4,525 level, which is also like a bit of a horizontal level recently as well. Yeah, then if that can be overcome, then I think we will see a retest of the previous highs at 4,575. So overall for STI, I think still demonstrating strength despite the recent market weakness. And then moving on to Moving on to the local banks, first one, DBS. I think DBS, we can see that it's still pretty strong, just moving sideways at the highs. And yeah, I think it's around somewhere close to the 20 to 50 SMA level, this yellow line and green line, there tends to be some support along the way. So I think the recent slight pullback, I think we probably could find some support if it does test like 50, 52, 30, 50, $52.30 around there, which is a 50 SMA level, and as a swing low over here as well. So I think for now, it's probably just moving sideways, but still a very nice, strong uptrend. Then for UOB, you can see weakness in the chart where it just has been trending downwards since late July this year, lower highs, and then recently after the earnings gap down below this 34.40 level, this has retest of this has held as resistance. So I think for now, most likely we will see some sideways consolidation at the lower range between like 33.50 to 34.40 over here, where price has been just moving sideways since after the results. Yeah. Then below 33.50, the next key support level is around, I think it's around somewhere around $33, the psychological level. And yeah, so that's for UOB, still showing some weakness unless you can overcome this 34.40 level. And next one, OCBC. OCBC is priced overall still quite strong. A bit of a pullback recently. And yeah, so I think for now, there's some pullback in terms of the weekly. Yeah, we could be pulling back towards the weekly 5 MA level, I feel. So previously, when doing some of the stronger rallies, we've seen price pull back towards do a retest of the 5 MA again, then before rebounding, like for example, end of last year. And so I think for now, support could be around $17.90 about there. If it does retest the weekly 5 MA, then there's also 20 MA daily support around $17.79 for now. Yeah, so I think maybe some slight pullback for now, then we could see some rebound if it does retest these support levels. Next one is on UOB Kay Hian. Yeah, so for UOB Kay Hian, I think for now, in terms of the share price, some slight weakness, but there hasn't been any confirmation yet. So since like the double top over here around 263, then price pulled back and moving sideways with a bit of lower high around 253, still cannot be, where price didn't overcome it. And in terms of this trend line support, price is slightly hovering around there. So it's around 245 right now. If there's a break below like 241, the recent lows, then we could most probably see a retest of the next support level around 231 to 235 area. Yeah. Then yeah, but for now, no much signs of a very strong weakness yet. Just moving sideways and hasn't had the strength to go to do a breakout of 253. Yeah. So I think for now, most likely I think this support will still hold around to this 235 area. Then if we can't break up of 246 over here, then just most likely continue sideways since end of September. Okay, next one is on the HST, which is the Hang Seng Tech ETF. Yeah, so for Hang Seng Tech ETF, I think it's been quite a bit of a pullback since the peak of $1.08. Now it's around 90 cents. I feel that most likely you'll get some support close to this area over here where there was a resistance in the past, like 86 cents to 88 cents area. So during the first half of this year, when it did a recovery from the April sell-off, the price actually consolidated over here from May to July for quite a period of time, finding resistance at 86 to about 88 cents area. So currently, I think price is quite close to this level. I think support should be able to hold around here because it's around the 200. It's slightly below the 200 SMA level as well, which is quite a long-term support that has held during the April dips. Yeah. In terms of the weekly wise, it's also quite close to the 50, is around the 50 SMA area already, which also is a support during April. Yeah, so I think most probably the 86 to 88 cents level should be able to be a very strong support level for price to rebound from for the HST. Yeah. Let me see what other questions. Okay, oil tech and CNMC, CSE Global and Soybean. Yeah, so for oil tech, I think price is still showing weakness. Where the key downtrend resistance line is still holding since start of September this year, and recently mid-November also broke down 82 cents. Currently testing this 71 cents support level and a bit of a slump, a bit of a slight rebound. But still unable to show any signs of reversal yet, where it's still trending below the 510 MA levels. So I think most likely we could still expect this weakness to continue on for now. Yeah, unless it can try to break above 76.5 cents and also this 10 MA level, then we might see some slight rebound to retest this trendline resistance. Yeah. I think for oil tech, probably look at the next support levels downwards. The next support level is around like 67 cents. And then next one is around maybe 63 cents about there. So some of the previous levels in July, June to July this year. Okay, next one on CNMC gold mine. So for CNMC gold mine, also some weakness in terms of the charts. Where there's a price broke down the 50 SMA level recently, and then I think the next key support level I will feel is around the 90 cents level over here, where there was a swing low in middle of September this year, and it's quite close to the 100 SMA level, which is I think will rise towards that level. So, and then I think also in terms of the recent breakdown levels, in terms of the recent price action, there's also multiple tests of this support at 104, 105. And looks like there's a breakdown recently. So I think with the moving average sloping down, I will expect some further pullback. If 98 cents cannot hold, then I think it could go towards 90 cents to retest 90 cents as a next stronger support level. Okay, then next one is on CSE Global. So for CSE Global, I think overall it's still a very strong uptrend. And recently, I think it's just moving sideways. So the key, I think, for this is to sustain the short-term momentum, where I think it must hold this. It must try to hold 94 cents over here, and also the 5 and 10-day short-term averages to continue a strong momentum upwards. If not, I think it might do a bit of a slight pullback for now, with the next key support level maybe around 87 cents, and then next one is around 81, somewhere close to 81 to 82 cents level. Yeah, then overall in terms of the trend wise, I think it's following this uptrend channel in blue. So whenever it comes down towards the channel support, then I think it's able to get a stronger support. Yeah, currently it's around the channel resistance. Yeah, so just moving sideways, and if it can't hold 94 cents, then I think we could expect some short-term weakness pullback from the resistance area. Okay, next question is on soil build. Yeah, for soil build, I think some very strong trend, but I think we can see some weakness in terms of the charts recently, especially since middle of November, where price actually broke down this consolidation support at $3.33, and then also this short-term trendline support as well. So in terms of the moving averages, also slightly below the 50 SMA for now. So I think there's all some signs of weakness with the moving averages sloping down, where previously it was holding as support and trending upwards. So I feel that for soil build, most likely we will expect some a bit of further pullback to come to retest some of the previous levels, like around close to $3 as a psychological level. And then below that, the next one is somewhere close to 284. Yeah, so I think for soil build, we could see some share price pullback on the weekly also break down below 5 MA and 10 MA last week with this bearish candle. So I think that really shows the weakness, and we can expect some more pullback in the near term. Yeah, so I think it's about one. I think I will take maybe one more question on CATL. Yeah, so for CATL also, recent share price weakness previously was a very strong trend, trending up steadily, but you can see weakness since middle of November. When the breakdown of 520, this horizontal support level, and also this trend line support. So I think currently it's around the 100 SMA level. But I think for now still no any confirmation yet, and there's also high volume selling recently, higher volume selling recently. So I think for now most likely we could still see some maybe some pullbacks towards some of the next support level around 440. Then the next afterwards below is around close to 400, somewhere closer to 405. Yeah, as a next key support levels. Yeah, so that I think about one. I think there's still quite a lot of questions. There's still quite a lot of TA questions as well. But sorry, I'm unable to answer all of them in view of time. But feel free, if you are free to 8 to 9:15, you can feel free to join in and attend the session where I will talk more about the TA. Yeah. So thanks everyone for your attendance as well as all your questions, and yeah, we look forward to seeing you all again in our future webinars. Yeah. So thank you all, and on behalf of my team, I'd like to wish everyone a great week ahead, and hope to see you all again next week. Yeah. Thanks. Bye bye.